The dominoes begin. Latin American debt crisis, 1982. It is the morning of August 12, 1982. Washington, D.C., Jesus Silva Herzog, the finance minister of Mexico, has flown to the American capital for a meeting. He is not a man given to drama. He is a professional economist, a careful and serious official who has spent his career navigating the complex financial terrain of one of the largest economies in Latin America. He has not come to Washington for a courtesy call. He has not come to discuss the agenda of the next multilateral summit or the details of some bilateral trade arrangement. He has come to deliver news that the United States government, the International Monetary Fund, and the entire international financial system have been hoping never to receive. Mexico cannot pay. Not this month's payments. Not next month's payments. Not the obligations that fall due systematically across the coming year on the enormous pile of debt that Mexico has accumulated through the 1970s. The loans from Western banks, denominated in U.S. dollars, carrying interest rates that seemed manageable when they were signed, and that have since been repriced by the most dramatic tightening of American monetary policy in the post-war era. Paul Volcker, chairman of the Federal Reserve, had raised U.S. interest rates to 20%. 20%. Not to punish Mexico. Not with any awareness of what it would do to governments on the other side of the world that had borrowed dollars at floating rates, but to strangle an inflation that had reached double digits and was threatening to permanently undermine confidence in the U.S. dollar and the entire American economy. It had worked. American inflation was coming down. The medicine was brutal, but the patient was responding. The problem was the side effects. Mexico had borrowed billions of dollars at floating interest rates, rates that moved with the U.S. benchmark. When that benchmark was 5%, the loans were manageable. When it hit 10, they were difficult. When it hit 20, the interest payments alone exceeded what the Mexican government could generate from its entire export revenues. And Mexico was not alone. Brazil had borrowed. Argentina had borrowed. Chile, Venezuela, Peru, Colombia, Bolivia. Every significant economy in Latin America had spent the 1970s accepting loans from Western banks that were happy to recycle the petrodollar surpluses of the OPEC nations into sovereign lending to developing countries. Three assumptions underpinned the whole arrangement, all wrong simultaneously. And Jesus Silva Herzog, sitting across from his American counterparts in Washington, D.C., on August 12, 1982, was the first man to say out loud what the arithmetic had made inevitable. Mexico was going to default. Welcome to Market Mayhem, when greed meets gravity. I'm your host. Today, the decade that destroyed a continent. How a decision made in Washington, the right decision, for the right reasons, for American reasons, created a catastrophe that nobody in Latin America had voted for, and nobody in Latin America could escape. Episode 8. Let's begin. To understand the Latin American debt crisis, you need to understand where all that money came from. It is 1973. OPEC, the Organization of the Petroleum Exporting Countries, announces an oil embargo against nations that supported Israel in the Yom Kippur War. The price of oil quadruples almost overnight. The oil-exporting nations of the Middle East, Venezuela, and elsewhere suddenly find themselves accumulating dollars at a rate they have no domestic capacity to absorb. These dollars, petrodollars as they came to be called, flood into the Western banking system. The major international banks of New York and London find themselves with vast quantities of deposits they need to put to work. Interest rates in the developed world are modest. The returns available from lending to developed economies are thin. The banks need borrowers. Latin America needed infrastructure. Brazil was building. Roads, dams, steel mills, power plants. the ambition of a developing economy determined to industrialize. Argentina was expanding. Mexico, sitting on enormous oil reserves of its own, was investing in the extraction infrastructure to turn those reserves into revenue. The entire region was in the middle of a development surge, and development requires capital. The banks offered sovereign loans at floating interest rates. The sovereign governments accepted. The arrangement seemed rational on all sides. Sovereign nations, as any economics textbook of the era would have told you, do not default on their debts. The implicit government guarantee of a sovereign loan made it, in the bank's analysis, essentially safe. And the floating rate protected the banks against movements in U.S. interest rates. If rates rose, the loan's return rose with them. What the bank's analysis did not adequately stress test was the scenario where U.S. interest rates rose so dramatically, so quickly, that the interest payments became impossible to service, regardless of any realistic assessment of the borrowing country's economic capacity. That scenario arrived with Paul Volcker. Volcker had been appointed Fed chairman by President Carter in 1979 with a specific mandate: break inflation. American inflation in the late 1970s had reached double digits and was accelerating. The purchasing power of the dollar was being eroded year after year. The credibility of U.S. monetary policy was at stake. Volcker's response was the most aggressive monetary tightening in American post-war history. The federal funds rate, which had been around 10% in 1979, was pushed to 20% by mid-1981. American inflation broke, eventually. The recession that Volcker's rate hike caused was severe. Unemployment hit almost 11%. But the policy worked. Inflation came down. The dollar stabilized. U.S. monetary credibility was restored. And Latin America, whose governments had borrowed at floating rates tied to that same U.S. benchmark, found that the interest payments on their loans had doubled, then tripled, then quintupled from what they had been when the loans were signed. Mexico's debt service, at 20% U.S. rates, consumed more than its entire export earnings. The loan that had been manageable at 5% had become impossible at 20%, and there was no mechanism to renegotiate. The banks were protected by the floating rate. The sovereign governments were exposed to it entirely. Through the 1970s, the flow of petrodollar lending to Latin America was not a trickle. It was a flood. Between 1970 and 1982, Latin America's external debt grew from approximately $29 billion to over $327 billion, an 11-fold increase in 12 years. The growth in lending was matched by a growth in the sophistication of the instruments, syndicated loans involving dozens of banks across multiple countries, recycled through correspondent banking relationships, repackaged and sold in secondary markets. The banks had strong incentive to lend. The returns on sovereign loans were better than anything available domestically. The competitive pressure to participate in major syndicated deals meant that any bank that pulled back risked losing relationships and market position. The rating agencies, the regulatory frameworks, and the conventional wisdom of international finance all supported the thesis that sovereign lending to growing economies was a safe and productive use of capital. Individual loan officers and country analysts within the banks were sometimes uneasy. Some of them wrote internal memos questioning the aggregate exposure being built up. A few raised concerns about what would happen if interest rates moved adversely. These concerns were not, for the most part, acted upon. The reason was a phrase that had entered the language of international finance, and that, repeated often enough, had come to function as a substitute for analysis. The phrase was, "Countries don't go bankrupt." It had the feeling of an axiom, a settled truth, something that the history of sovereign finance had established beyond serious question. And it was not entirely wrong. Major industrialized nations, with their own currencies and deep capital markets, had very rarely defaulted on external obligations. But Latin American nations, borrowing in dollars they could not print, dependent on commodity export revenues that could be devastated by global price movements, and carrying debt loads that were reaching multiples of their annual GDP, these were not in the same category as the United States or Germany. They were exposed to a very specific kind of vulnerability that the axiom did not address. When Volcker's rate policy made it impossible to service the debt, the axiom broke. Mexico went first. But the entire banking system knew, in August 1982, that Mexico was not the last. The exposure of major U.S. banks to Latin American sovereign debt was staggering. Citicorp's Latin American exposure was estimated at more than its entire capital base. The same was broadly true of the other major money center banks. If the dominoes fell, if Brazil defaulted after Mexico, Argentina after Brazil, the U.S. banking system itself faced potential insolvency. The stakes suddenly were not just Latin American. August 12, 1982, Mexico's announcement. The immediate reaction in Washington and at the International Monetary Fund is controlled panic. The implications are understood within hours. Mexico cannot pay. Brazil's situation is almost identical. Argentina is in crisis. If the IMF and the U.S. government do not act immediately and decisively, the contagion will spread across the entire region and potentially destabilize the global banking system. The IMF mobilizes emergency lending. The U.S. Federal Reserve coordinates support. A $3.9 billion emergency loan package is assembled for Mexico within weeks. In exchange, Mexico agrees to conditions, an austerity program designed by the IMF to restore fiscal discipline and generate the surplus needed to service its debts. The conditions are brutal. Government spending cut, subsidies removed, public sector wages frozen, the peso devalued, imports restricted. The effect on ordinary Mexicans is immediate and devastating. GDP contracts, real wages collapse, unemployment rises. A middle class that had been growing through the 1970s sees its purchasing power destroyed. Inflation, which the austerity measures were supposed to control, remains elevated as the peso devaluation flows through into import prices. Brazil follows, Argentina follows. Chile, which had already undergone a severe financial crisis of its own related to its banking sector, follows. Venezuela, Peru, Bolivia. The entire region enters what economists later name the lost decade. 10 years of economic contraction, hyperinflation, rising poverty, and human suffering on a scale that statistics inadequately capture. At its worst, Bolivia experiences inflation of over 24,000% in a single year. Argentina's inflation reaches several thousand%. The middle classes of multiple countries, people who had worked for decades to build savings and security, see the purchasing power of their money simply destroyed. The IMF's role in managing the crisis is, to this day, contested. Its prescription, austerity, devaluation, structural adjustment, restored fiscal order in the narrow sense. The loans were eventually renegotiated through the Brady Plan of 1989, which converted sovereign debt into tradable bonds, allowing a partial write-down and providing a path out of the crisis. But the human cost of the decade, the lost growth, the destroyed savings, the poverty, was borne entirely by the people of Latin America, who had not designed the loan structure, had not controlled the interest rates, had not made the decisions that created the crisis, and received nothing from the bailouts except conditions attached to survival. The major U.S. banks, whose reckless lending had helped create the crisis, and whose balance sheets would have been destroyed by large-scale defaults, were protected by a combination of IMF intervention, debt renegotiation, and the implicit guarantee that the U.S. government would not allow its major financial institutions to fail. The privatization of profits and the socialization of losses. In 1982, in Latin America, it was not a theoretical critique. It was what happened. The Latin American debt crisis did not end cleanly. It wound down slowly, painfully, over most of the 1980s, with different countries emerging from it at different times through different combinations of renegotiation, write-downs, and the Brady bonds that eventually provided a structured resolution. The social consequences lasted far longer than the financial ones. A generation of Latin Americans grew up during the lost decade under conditions of economic uncertainty, hyperinflation, and institutional instability that shaped their relationship with financial systems, governments, and money itself in ways that persist today. The distrust of banks, the preference for dollar-denominated savings, the wariness of sovereign debt. These are not irrational cultural traits. They are rational responses to lived experience. The crisis also reshaped the politics of the region. Austerity imposed by the IMF as a condition of emergency lending created deep resentment of international financial institutions that in some countries has never fully dissipated. The perception that the rules of the international financial system were designed by and for the wealthy nations, and that developing countries bore the costs of the wealthy nations' monetary policy decisions, was reinforced by the empirical reality of what had happened. It was not an unfounded perception. The regulatory response in the banking sector took years to materialize. The Basel Accords, the international framework for bank capital requirements that governs how much capital banks must hold against their loan books, developed in part as a response to the risk concentrations that the Latin American debt crisis had exposed. Banks holding sovereign debt at excessive concentrations, without adequate capital to absorb losses, was identified as a systemic vulnerability. The Basel framework was designed, among other things, to prevent it from happening again. It did not entirely prevent it. The European sovereign debt crisis of 2010 to 2012, with its own cascade of Greek, Irish, Portuguese, and Spanish sovereign stress, had structural echoes of 1982 that were impossible to ignore. The Latin American debt crisis teaches three lessons that are directly relevant to anyone who holds any position in any market that is sensitive to interest rate movements. The money lesson is about floating rate exposure and the asymmetry of risk. The banks that lent to Latin America at floating rates thought they had protected themselves against interest rate risk. They had. When rates rose, their loan income rose with them. But they had transferred that risk entirely to their borrowers, governments whose revenues were fixed in real terms by what their economies produced, and which had no mechanism to generate additional income when their debt service costs tripled. In modern markets, any position funded with variable rate borrowing, margin accounts, floating rate mortgages, corporate debt with variable coupons, carries the same asymmetry. When rates rise, the cost of carrying the position rises. The position itself may not change in value, but the cost of holding it does. Always understand whether your borrowing cost is fixed or floating, and what happens to your position economics if the floating rate moves against you. The method lesson is about correlation and contagion. The domino effect of 1982, Mexico, then Brazil, then Argentina, then the rest of the region, is a perfect demonstration of how apparently separate markets become correlated in a crisis. The Latin American sovereign loans were, in theory, diversified. Different countries, different industries, different project types. In practice, they all shared a single critical vulnerability: floating rate dollar debt in economies that could not devalue their dollar obligations. When that vulnerability was triggered by Volcker's rate policy, the diversification was irrelevant. They all fell together. In modern portfolios, diversification that does not account for common underlying risk factors is not genuine diversification. Identify the actual exposures that cut across your positions, the interest rate sensitivity, the dollar exposure, the commodity price dependency, and understand what happens to all of them simultaneously when that factor moves adversely. The mind lesson is about the difference between an axiom and an analysis. Countries don't go bankrupt was not a lie. It was a generalization that had been true for long enough that it had stopped being examined. It had become an axiom, accepted without testing, applied without qualification, and used as a substitute for the analysis of specific circumstances. In trading, the most dangerous beliefs are the ones that feel like settled truth, the ones where being skeptical feels unnecessarily contrary. Markets always recover eventually. Diversification protects you. The central bank won't let it fail. These may be broadly true. They are not universally true. Test your axioms regularly. One man in Washington. A decision that was right for the right reasons. American inflation had to be broken. 20% interest rates to do it. And across an ocean and a continent, governments that had borrowed dollars they couldn't print, at rates they couldn't control, for projects they were committed to completing, watching their debt service costs become mathematically impossible. They had made no monetary policy errors. They had not voted for Paul Volcker. They had not designed the floating rate structure. They had borrowed from banks that were happy to lend, at rates that seemed manageable, for projects that seemed sound. And they spent a decade paying for a crisis that was, in significant part, the consequence of someone else's decision. This is the lesson that the Latin American debt crisis adds to the canon. Markets are connected. Decisions made in one economy have consequences in another. The interest rate set in Washington determines the affordability of debt in Bogotá and Buenos Aires and Brasilia. A monetary policy decision made for entirely sound domestic reasons can constitute an existential crisis for another country that had no vote and no voice in the decision. In modern markets, with global capital flows and dollar-denominated debt reaching every corner of the world, this connection has not weakened. It has deepened. Next time on Market Mayhem, one Monday morning in October 1987. The Dow drops 22%, the largest single-day percentage decline in stock market history. The machines did it, and the system nearly broke. Black Monday, Episode 9. If today's story changed the way you think about interest rate risk and the connections between markets, take the free mind, method, money assessment at CompleteTradersEdge.com/assessment. Links in the description. Subscribe so you don't miss the next disaster.